Welcome from the desk with Pat Moran. It's Friday. Wow, what a crazy week we've had in the stock market. It's like a heart monitor, up and down, up and down. That volatility ultimately is what hurts a lot of investors because they panic. They don't stick with their strategies. They see this volatility and they're like, oh, I don't want to lose my money, so I'm going to sell. As a matter of fact, Dalbar, which is recognized as the industry leader on studying investor behavior, says investors on average only stay in the market for about 4 years, and they average about a 3% rate of return. The market is not a short-term game. It's not something that you time. It's not something that you do today and sell tomorrow. Ironically, most investors do the exact opposite of what they should be doing. When the market's here, they buy. When the market's there, they sell. When the market's there, buy. When the market's here, sell. Do the exact opposite. The second thing that we always run into this volatility is on these drops, it's a nice opportunity for you to add some money potentially if it sticks with your plan and what you're trying to do, because you're buying things a little bit on a discount. I ultimately say if a stock was $10 and I loved it at $10 and now I have a chance to buy it at $5 and nothing's changed other than the price has dropped, I'm going to take advantage of that discount. Ironically, in our personal lives, when it comes to shopping and consumer behavior, we're always looking for the discount. But when it comes to the stock market, we're like, oh, I got to run for the hills. I got to get out. So stock market investing is a long-term game. Do not get emotional about what's going on with your investments. If it's for retirement, if it's for kids' college funds, and you have 10, 12, 15 years to go, stick with your strategies. Take advantage of the fluctuations and don't panic. Last week we had about an 800-point drop. Today the market was down 450 points. It's on the recession fears that we have out there, that the economy may be slowing. I know Trump is going to the G7 conference this weekend, and the biggest topic is, are we heading into a worldwide slowdown, a recession? The market and interest rates are potentially saying there might be a recession on the horizon and things slowing down. Stocks and companies' prices contracting, companies pulling back a little bit because consumer demand maybe isn't going to be as high. All of these things are nothing more than static. If you are a long-term investor, then you need to be sticking with your strategies. You not should be selling on when things are taking a dump. When things drop at 800 points, go with reverse psychology. Rather than panicking, let's add some money or take advantage of this weakness to be able to add to our positions for our long-term strategies, assuming that it still makes sense for you. There's an endowment model out there that Yale and Columbia and Stanford and some of the most successful universities in the country have maintained, and that is about 50% of the portfolio is only in stocks. A portion in domestic stocks, international stocks, small company stocks, some cash, some bonds. The other 50% are in alternative investments. And traditionally what they look for is some of the upside with none of necessarily the craziness on the downside. So some upside potential, not taking big losses on the downside. People don't realize that when you have a big correction in the market like we had in 2008, that took 6 years for the S&P 500 to claw back to where it was when we had that event in 2008. Unfortunately, most people remember that 37% drop and forget about what happened earlier in that decade in 2000 to 2002. We had the tech correction. The market went down even more. It just happened a little bit slower, but it was more violent. It went down over 40%. Never in a 10-year period had we had two events like that where the market was down more than 30%. So in 2000, 2002, you ultimately spend 8 years coming back to where the S&P had been before that correction started. Now you add another 2008 where the market's dropping again. You add another 6 years. You spend 14 years essentially trying to make back where you were when the S&P started all this craziness. But if you had been buying... we've got a nice little test going on. I think maybe something I said caused the fire alarms to go off in panic. All right, the market's down 450 points. Everybody evacuate the building.
Good strategies, and I want you to evacuate. Don't give people good advice.
Stay patient.
Don't give
Hang
people
in
good
there. So subsequently, this Harvard investment model, what it does is it looks for some of the upside with none of the downside. If you're spending all these years trying to make back what you've lost, those are a number of years that your portfolio is going in reverse. And if you're a retiree, you're doing a systematic withdrawal, let's say, during that time, it's going to hurt. And it looks like your money's going to run out. Patience is going to be really tough, and it's going to be a gut wrencher. If anybody knows about gut wrenchers, it's me. So subsequently, again, we've got a panic scenario here at the office. Stick with it. 7 of the 10 worst drops in the stock market have occurred in the last 18 months. It's not a time to sell. It's a time to have that portion of your portfolio sticking with it and let it be invested. In this endowment model, though, they have 50% of their money invested in alternative strategies. Strategies maybe like a commodities, or maybe like private equity, maybe real estate. We like to talk about fixed indexed annuities or indexed universal life insurance, which is a terrific way to be able to participate in the market and not have the downside craziness that goes with it. And it's also one of the single best tax loopholes that's out there that nobody knows about or uses. So what I'd like to tell you is if you want to look for other ideas, we're happy to help you here at Bright Advisor. But the big message in all of this is stick with your long-term strategies, stay diversified. If this is driving you nuts, then let's talk about some ways that we can still give you some of the participation, but eliminate a lot of this. So this has been Pat Moran. Thanks for listening today. And I guess I got to leave the building because of this fire alarm or this upset that I created by what I was saying. Take care. Hey, thanks for listening. If you find yourself thinking, man, this guy kind of sounds like he knows what he's talking about. Maybe I should have him take a look at my portfolio or have him help me with my investments. Maybe get a second opinion. Go to brightadvisor.com and get in contact with us. We're happy to help.